The Reserve Bank is set to release its final decision of the year on interest rates, and it's almost certain rates will move higher for the 8th consecutive month, adding to pressure on home borrowers, with mortgage payments set to rise again. I'm joined by business reporter Alicia Barry, who's here in the studio. Senior business correspondent Peter Ryan is outside the Reserve Bank, and chief economist at PwC, Amy Oster, also joins us now. Apologies for the blank screen. Alicia, we'll start with you. So economists are expecting another interest rate rise today.
Yeah, that's almost certain. The economists surveyed by Icon, 30 of them in fact, all think that we will see interest rates increase by another 1/4 percentage point, taking the cash rate from 2.85% to 3.1%. Now, that is the highest level if it does come off in 10 years. The last time we saw interest rates above 3% was back in December 2012, when they were sitting at 3.25%. If we look at the range of forecasts, markets are expecting the cash rate will peak at around 3.5% in November next year, before starting to moderate toward 2024. So it does look as though markets are implying that the cash rate will be higher for longer. And when it comes to economists' forecasts, of course, the range is anywhere from 3.1%, which we are expected to hit today, to 4.1%. And that does, as you alluded to, have consequences for those who are repaying a mortgage or trying to get one, because we know that rising interest rates are cutting borrowing capacity and starting to weigh on home prices. But of course, there's always a lag in interest rate increases, so the full effect will be felt probably early next year.
Peter Ryan joins us from outside the Reserve Bank. Peter, we know that there's a lag between the rate increases and when they're felt in the economy. What's the RBA going to be focused on in its deliberations?
Well, good afternoon. I think the Reserve Bank's going to be focusing on doing whatever it takes to get inflation down. We know that inflation's heading towards 8% by the end of the year. That's way above the 2 to 3% target band. We did see a small drop in the October inflation in the year to the end of October of down to 6.9%, a bit of a surprise, but that's not going to be enough to satisfy the Reserve Bank. They're seeing pressures from wages mounting, a lot of money going into the economy, even though consumers are starting to get a little bit cautious, household budgets are trimming back. But it's not going to be enough. We'll find out in a few minutes, and it's almost certain the Reserve Bank will increase the cash rate by 1/4 percentage point.
Amy Oster, if we can bring you in, it's been a very steep rise in rates so far. If they go up again, they would have moved 3 full percentage points this year. How high do you think they will go?
Oh, I think we're pretty much in line with the market consensus, so up to about 3.6%, but I think the RBA may move a bit faster than slower just to get ahead of inflation. So I think we may be toward the end of this rate rise cycle before the May budget.
So when you say, Amy Oster, that the RBA might move quicker, does that mean that you think that come February there might be another rise?
I think there could be. Some will. We're very fortunate now that we've got monthly CPI, which is a great indicator, and that's pretty recent. So kudos to David Gruen over at the ABS for getting that going. But if we see inflation start to fall off sooner, or if we see unemployment start to pick up post-Christmas, but I think it would have to happen pretty quickly for the RBA to go on pause.
Yeah, Amy Oster, you mentioned the monthly CPI figure. The figure that came out last month for October was at 6.9%. What was your reading of that?
Well, positive in the fact that it edged lower than the September reading, but as Peter said, still quite a bit above the RBA's target band of 2 to 3%. The RBA governor has said and repeated many times recently, the RBA is looking for inflation to be in the band over the cycle. So that doesn't mean that they need to get inflation below 3% in order for the rate rise cycle to stop, but they do need to see that it is headed in that direction.
And Amy Oster, we've already seen the rate rises that have come this year having some impact on the housing market. Where does PwC see that going?
Well, So there is some impact on the market, and I think we talked about a few different things. There's demand for housing, and then there's also, if you're talking property prices. So property prices are back at nearly pretty much zero growth over the year. But of course, previous to that, we had a very big increase in housing prices. So I think kind of end-to-end.
Amy Oster will interrupt you there because Alicia has the details of the RBA decision.
As expected, Karina, we have seen a 25 basis point or quarter of a percentage point increase to the cash rate, taking it to 3.1%, the highest level in 10 years, as everyone expected broadly in terms of economists and the market. On the basis of that increase, we have seen the dollar start to rise a little bit against the greenback, but certainly no surprises here. The last decision for the year and the last one until February next year. So very much in line with expectations. And I think what really the market and economists are going to be looking at is what Philip Lowe does say in the statement, because this is not a surprise, but the forward guidance that he gives about whether or not they're going to take a pause next or continue to keep pushing, as Amy Oster was alluding to, the likelihood of, will be really key. I know Peter Ryan is looking through that statement very closely now.
Yeah, we'll come to Peter in a moment. But Alicia, what will this mean, this 25 basis point, quarter of 1 percentage point increase mean for people who have mortgages?
Well, that's right. This is the fastest trajectory in terms of interest rate increases since the early 1990s. And we do have a graphic which shows just how steep this trajectory has been. We've gone from, as you alluded to, 0.1% in May to now 3.1% in the space of 10 months. And you really do have to go back to the 1990s to see that ahead of the recession. So it is a very steep run up for people who have mortgages. Of course, it's better for those who have savings. But when it comes to 1 in 3 Australian households who do have a mortgage and who are going to have to find extra cash, and we know the RBA has been talking a lot about savings buffers, you can see there that this has just increased again how much they're going to have to find each month. So if you have a $500,000 mortgage, when you factor in the increases from May to December, you'll now be paying an extra $834 a month. For $750,000, that May to December increase is over $1,200 a month. And for those who have $1 million mortgage, which is the case for many in the very expensive cities like Sydney and Melbourne, particularly those who bought in the last 2 years, because we know prices had run up very quickly, they're going to be paying an extra $1,600 and a bit per month after that May to December rate rise is factored in. So certainly likely that we're going to see that have an impact on consumer spending, and something the RBA has said numerous times that it's looking at.
Let's bring in our senior business correspondent, Peter Ryan, who's outside the Reserve Bank. Peter, you've been looking over that statement from Philip Lowe. What are some of the highlights?
That's right. Philip Lowe's released a statement, as they always do after the deliberations. As flagged, the Reserve Bank Board has said that they are resolute in doing what it takes to get inflation back closer to that 2 to 3% target band over time. In the final paragraph, the board expects to increase interest rates further over the period ahead, but it's not on a preset path, closely monitoring the global economy. Makes the point that they recognise that monetary policy operates with a lag, and as we mentioned earlier, the Reserve Bank Board has acknowledged that some of the pain from the previous rate rises before this one are yet to be felt. So the Reserve Bank are resolute in doing what it takes to tame inflation. So in many ways, no changes to the strategy whatsoever. They're going to be doing whatever they need to do to pull inflation down, even if that hurts households and perhaps even pushes the economy into a slowdown that could end up with a hard economic landing.
Let's go to Amy Oster, the chief economist from PwC, picking up on what Peter Ryan was saying there from the RBA's statement about needing to tame inflation and closely monitoring the global economy. If there is a recession overseas, is that likely to be felt here in Australia?
Oh, well, it depends on who's having it and how big it is. I think at the moment what the market is expecting, which is potential recession in the United States and in parts of Europe, but a short and shallow one. I think that doesn't have an overwhelming impact on Australia, and that seems to be what's being priced in at the moment. Not really a recession in our part of the world over here in Asia Pacific. And if anything, the potential for easing of COVID restrictions that we've seen out of China over the past week or so will start to ease the Reserve Bank's concerns about supply chain pressures and those prices that are coming, those pricing pressures coming in from imports. So in that sense, there's some, I suppose, countervailing possible positives from what's happening overseas.
Peter, a week ago, Philip Lowe made a surprise apology for comments that rates would remain low until 2024. How crucial is it that the RBA gets its policy right now?
Well, it's critical, and Philip Lowe's apology, or he said he was sorry if any borrowers took his signal about rates remaining low till 2024, was seen as a promise. The Reserve Bank's repeatedly made the point that it was not a pledge, it was not a commitment, but unfortunately they acknowledge in their forward guidance policy and also in Mr Lowe's comments that some borrowers took that as a signal that they should borrow big. And of course rates are rising, as we've seen today, the 8th in a row, and people are paying a lot more for their loans at the moment. And of course next year the crunch is going to be coming when we have a lot of borrowers on fixed rate loans coming off those mortgages into a much higher rates world.
And Amy Oster, we talked about it a second ago. It's Alicia Barry sitting here in the studio with Karina. The RBA has been talking about that narrow path that it's treading in order to balance growth and stamp out inflation. In this statement, it's saying growth of around 1.5% in 2024, which will feel very, very slow, particularly given what we've experienced recently. How much of a risk do you think there is of a recession occurring because of the RBA's policy?
It's a really good question, and I think definitely we're in for a period of slower growth, and that will be largely consumption driven, so a slower rate of consumption. But the extent to which this really feels like a recession is an important distinction, because when people really feel there's recession-like conditions, it's when unemployment starts to rise. So people feel a recession when they feel that their income is under threat, less so their expenses, which a lot of households can manage, feel a greater sense of being able to manage. So when we have really tight labor markets, as we do right now, record low unemployment, so long as there is a moderate and only gradual rise in unemployment, I don't think we're going to feel like we're having a recession here in Australia, even though growth is expected to slow.
And Peter Ryan, was there any indication in that statement from the RBA governor about there being a pause anytime soon in these rate rises?
Well, I've looked through the statement for any signal about that. No sign that they will be pausing, and you can only read between the lines that they will only pause when they see inflation peaking and then starting to fall, and that they're actually seeing tangible evidence that their rate rising strategy is working in the general economy. There were a few comments about concerns about wages rising. Philip Lowe, the Reserve Bank governor, has made the point that he wants workers to temper and be sensible with their wage demands. They're concerned about seeing what would be a very damaging wage price spiral, where wages start chasing inflation and you get into that situation where inflation keeps mounting, and it's a circular battle. So that's one thing that they're looking at. But no sign in this statement at all that the Reserve Bank might be looking at stopping anytime soon, and we are expecting the Reserve Bank to continue. They don't meet in January because they have a holiday. They're back in February. So I think that borrowers should be expecting to see 2, maybe 3 rate rises next year. And so the commentary in that next statement that we see in February will be interesting. Of course, there's a lot of water to go under the bridge. We have problems in China at the moment with the lockdowns and restrictions from the pandemic. And also we saw earlier this week that Australia's budget position is actually looking pretty good despite some of the other dire forecasts out there. But if China starts pulling back on its demand for our iron ore and coal, that could actually be creating other complications. And it will be interesting to hear what the Treasurer Jim Chalmers says in a few minutes' time as he absorbs the meaning of this statement.
So, Alicia, as we heard there from Peter Ryan, the RBA doesn't meet in January. It'll meet again in February. How have the markets responded to this rate decision?
Well, that's right. Shoppers will get, and homeowners and all of the people who are affected by interest rates will get a bit of a break over January to prepare for a likely increase in the following months. But in terms of how the market has reacted, Karina, it's really been a factor of the dollar jumping against the greenback. It's up around 0.5% in the last little while as I suppose traders digested that fairly hawkish tone from the RBA. As Peter alluded to, there's no real sign that they're going to slow down on their push to stamp out inflation. As for the market, it hasn't really changed all that much. It was down before we started talking and has continued to remain down. But certainly a jump in the dollar, as would be expected when rates are moved higher. Karina.
Our business reporter Alicia Barry, Peter Ryan, our senior business correspondent, and Amy Oster, chief economist at PwC. Thank you all so much. We are expecting the Treasurer Jim Chalmers to speak shortly following that Reserve Bank decision. We'll bring that to you live here on the ABC News channel when it begins very shortly. Well, exports of Australian farm products are expected to reach near record highs this financial year despite a cold and wet spring. But there's some bad news for consumers, with fruit and vegetable prices expected to rise this month. Clint Jasper has the details.
There's some pretty impressive numbers in the report that's come out from ABARES, the National Commodity Forecaster, today. And principal among them for me was the $72 billion worth of farm exports expected this year, because it tells us a lot about what's going on at the moment. Namely, that there's some really high commodity prices caused by shortages around the world. The same La Nina that's causing flooding here in Australia is causing some big droughts in other grain growing regions. So Australian farmers have a lot to sell at a time when the prices are really high.
So that's the good news, but the floods are going to have an impact in some areas.
Yeah, mainly in New South Wales. They've really borne the brunt of it in that state. The harvest there this year is expected to be around 30% less than last year's, with about 16% of the crops abandoned. So it's a pretty sad situation for farmers there, especially around the Central West and the Riverina area. But in other states, there's been some really fantastic conditions. So WA and South Australia are expected to produce some of their biggest crops ever. And just last night, CBH, the grain receiver in WA, said that for the second consecutive day, it had smashed a record for how much grain farmers were bringing in to its receival sites. So overall, we're still producing a really large crop.
Food prices have gone up because of the floods. That's undeniable. Is there any relief in sight for consumers?
Do you want the good news or the bad news?
Let's go with the bad news first, then the good news.
Okay, so the bad news is that yes, prices are going to stay high. They are expected to peak in December. This is mainly for vegetables, and it's because Victorian vegetable growers have been hit with this cold, wet spring during their key growing season. So they need that run of nice, sunny, warm days to get the fruit really up and ripe and ready to hit the market, and they just haven't had that. So the yields are lower, and as a result, the prices are higher.
And how are farmers feeling right now, given that another wet summer is forecast along the East Coast?
They're a very resilient bunch, farmers. The main thing weighing on, I guess, most farmers' mind at the moment is that fuel and fertiliser, the chemicals they need to produce the crop, have all been so expensive this year that, you know, everything I've said about really high prices, it won't really translate into the same kind of profits that they got last year for their bumper crop, because the bills to produce this crop have been so high. So that'll really weigh on farm profitability this year, and I reckon that will be more front and centre of most farmers' mind than another wet summer.
Temperatures are set to soar across parts of Queensland from today, with the state's far west likely to hit the mid-40s. The heatwave comes after a cool start to summer for the Sunshine State. Here's Jonathan Howe from the Bureau of Meteorology.
So we are seeing a significant heat wave across Queensland, but more broadly across much of northern Australia, with severe heat wave conditions for parts of southeast Queensland, including Brisbane, and reaching even extreme heat wave conditions for central and northern parts of the state. And we see these extreme heat wave conditions extend even into the Northern Territory and northern parts of WA. So today we're seeing temperatures already in the mid to high 30s across large parts of central Queensland, into the mid 30s across the southeast, and even dipping into parts of northeast New South Wales. But from tomorrow, we'll see even more heat build across the west of the state. We are expecting to see temperatures climb well into the 40s for many locations, including Cloncurry, Longreach, as high as 46 degrees tomorrow in Birdsville. And for those in southeast Queensland, we will see those hot temperatures continue, peaking at 36 degrees in Brisbane and even up into close to 40 degrees for some of the western suburbs. So certainly a very hot number of days to come.
Yeah, 46 in Birdsville is extreme, but as you say, this hot weather does filter down into southeast Queensland. So what sort of precautions do people need to take?
Yeah, so for millions of people across southeast Queensland, this will be the first real long, prolonged period of heat across the state. And what that means is that there's really not much chance for the body to recover overnight, with minimum temperatures remaining quite high, followed by very high daytime temperatures. So really encouraging people to take the proper health precautions, because heat wave is the most dangerous natural hazard in Australia. So the Queensland Health Department has some really great tips to try to beat the heat, but most importantly, staying out of the heat of the sun when you can, drinking plenty of water, and of course to check on elderly and vulnerable friends and neighbours, and of course don't forget about your pets and your animals as well.
Jonathan, it's not just the heat, it's the humidity as well. How extreme is that expected to be over the next few days?
Yeah, so waters off the Queensland coast around the Coral Sea at record levels for this time of year. And what that means is it is pumping a lot more moisture onto the coast. So not just seeing these hot conditions, but also very, very humid conditions. And that really raises the apparent or feels like temperature. So even though it might be kind of 30 to 33 degrees in Brisbane, the feels like temperature could be much higher than that, with this really high levels of humidity extending all the way up the coastline. So that really does add to that heat stress on the body. So really reminding people to stay hydrated and stay out of the heat of the sun if they can.
And so you say heat wave conditions, but will it technically be a heat wave? Is it going to last 5 days?
So the Bureau's official definition of a heat wave is at least 3 days of above average temperatures, both daytime and nighttime. So across southeast Queensland, we are looking at low to locally severe intensity heat wave conditions. But for those across northern parts of Queensland, towards the Northern Territory and WA, we are looking at 6 to even 8 days of temperatures well into the 40s. So very much reaching and even exceeding that heat wave definition. So any which way you look at it, it's going to be a really hot number of days.
Oh, wow, 6 to 8 days. That's really tough. When can areas, the more populated areas of Queensland, say along the coast, when can they expect some relief?
So if you run along the coast, you will see some light sea breezes as well. But for those inland, particularly for parts of western Brisbane and towards the city as well, unfortunately, we will see these high temperatures continue until Thursday. That's when the cold change comes through, with a couple of showers and thunderstorms. But for those across the north of the state, unfortunately, we'll need to wait until at least the weekend into early next week. OK,
Jonathan Howe, thanks so much for the update.
Thank you.
For some people with post-traumatic stress disorder, having a dog isn't just about companionship, it's a bond that can be life-changing. But those seeking financial support for their assistance dogs say they've hit roadblocks and argue the system needs to change.
This is Toby.
Thank you.
He's more than just an average pet. And once his yellow jacket goes on, he switches into work mode. As a psychiatric assistance dog, Toby monitors his owner Sally and intervenes if her disability puts her in danger.
You can actually freeze and go into a trance, and you can't see through your eyes, you can't move your body. When I go into those trances, he's been trained to interrupt and bump me.
Sally doesn't want to be identified because she's a victim of historic abuse and domestic violence. She's been diagnosed with PTSD, anxiety, depression and another serious mental health condition called DID. But she credits Toby's training through charity Mind Dog Australia with transforming her life.
I'm so much happier. I can go to the shops, I can go to the gym, I can catch public transport, which I was never able to do.
Paying for Toby's training and upkeep has been a challenge. Sally was locked in a legal battle with the National Disability Insurance Agency to get support. The agency said she wasn't eligible because of the other mental health conditions she had on top of her PTSD. They also argued Toby's training didn't represent value for money.
I just was furious that they thought, oh, it's not worth it for you.
After 2 years, the case was recently settled after Sally hired lawyers.
We obtained funding for our client that covered training costs as well as maintenance costs as well as a back payment to the tune of around $8,000.
There's many people with complex mental health conditions who'd love to have an assistance dog like Toby, but their applications for funding are knocked back by the NDIA every year. Mind Dog Australia is one of the groups calling for the funding criteria to be relaxed so more people can have support. The NDIA refused to say how many people like Sally they're fighting in tribunals, but say they've funded about 500 assistance animals for a variety of disabilities over the past decade. Christian Silva, ABC News.
So just a reminder, we are expecting the Treasurer Jim Chalmers to speak shortly in Sydney. That follows the Reserve Bank decision to raise interest rates to their highest level in a decade. They now sit at 3.1% after that 1/4 percentage point increase. Soon as the Treasurer Jim Chalmers gets up, we'll bring that to you live on the ABC News channel. Time for sport with Charles Bryce with more on the Socceroos' return home from the World Cup.
They've been greeted by fans after Australia's most successful World Cup campaign. The country continues celebrating the team's run to the round of 16. The Socceroos beat Tunisia and Denmark with 1-0 scorelines to win 2 matches in a group stage for the very first time. They were defeated by Argentina in the knockout stage on Sunday morning, but striker Jamie McLaren says they've set themselves a high standard for future World Cups.
We played against one of the best teams and the best player that's ever played the game, so we can hold our heads high and know that it's been the best finish that Socceroos team has had at a World Cup, and now that's the standard.
And Karina, still with the World Cup, and Brazil has set a high standard as well, easily progressing to the quarterfinals by thrashing South Korea 4-1. In fact, the first half was a bit of a goal fest. The Brazilians hitting the back of the net 4 times within 36 minutes. A Korean defensive error led an opportunity for Neymar, and he scored from the penalty spot with his team then cruising in cruise mode. South Korea at least kept the South Americans scoreless in the second half and reduced the lead late in the game. In the other match, Croatia beat Japan in a penalty shootout after both teams were locked at 1-1 at the end of extra time. Croatian goalkeeper Dominik Livakovic saved 3 penalties before Mario Paslovic netted the winning spot kick in the 3-1 win.
Yeah, the Brazil versus Argentina semi-final looks the goods. Let's talk basketball, and the Illawarra Hawks have had a much-needed win.
They have, and in doing so, they've snapped a 9-game losing streak. They came up against Melbourne United at home. The final score was 93-79. Sam Froling was the hero for the Hawks as he set a career-high mark, 29 points, and was especially hot early, which put his side on the path to their second win of the season. He scored 16 points in the opening period as Illawarra produced their highest scoring quarter of any game this season. The Hawks then withstood a series of surges from the visitors as Melbourne sank to 9th on the ladder with their 5th loss in a row.
Charles, it might only be December, but the Brisbane Lions are already feeling the pressure of expectation heading into next year's AFL season.
Yeah, it's probably a pretty good problem to have as well. They've had 2 really good seasons, making the prelim this year as well, and they've bolstered their stocks in the trade period as well. And they were all on deck at the club's brand new Springfield headquarters for the first time yesterday, the facility looking pristine. But that pressure on the club has been welcomed by coach Chris Fagan. He says they've put themselves into a position where there's expectations and they're really excited. Karina, that is the latest in sport. I'll be back a little bit later this afternoon with more.
Charles Bryce in Adelaide. Let's check the weather with Stephanie Ferrier.
Well, this big cloud band is thanks to a combination of a trough, cold front and warm front that's triggering those heat wave and extreme fire danger warnings in northern parts of WA, including the Kimberley, Pilbara and northern interior and the top end, stretching all the way into Queensland. While further south, we have those major flood warnings for already sodden areas, including along the Lachlan, Murrumbidgee and Murray rivers. Now, that low in the Tasman with associated troughs will bring showers, gusty winds and some storms to Tasmania, Victoria and eastern New South Wales. And you can see on the totals that won't be great for those flood zones. On the Lachlan River, we're expecting to see flood levels similar to the 1990 flood at Hillston, and on the Murray, flooding higher potentially than 1975 at Warkle Junction, Boundary Bend and Wentworth. The capitals tomorrow, well, we're looking at Brisbane having a sunny day and a top of 33. Sydney will be mostly sunny and 28. Canberra mostly sunny as well and 26. Melbourne, you'll have a shower or two and 20 degrees. Hobart, a shower or two developing and 18. Over in Adelaide, it'll be a partly cloudy day and 22. Perth will have a possible late storm, but hot though, 31 degrees. And Darwin, a shower or two and a possible storm, a top of 34. Well,
that's ABC News for now. I'm Karina Carvalho. Stay with us. We are expecting the Treasurer Jim Chalmers to speak in Sydney. Gemma Vaness will be with you on the ABC News channel.
Do you mind if we shut this door? Yeah, thanks, mate. Cheers. Thanks, mate.
It's all right. Come around here.
Okay, good to go?
Yep.
Yeah, okay. Well, obviously I'll begin by wishing the Prime Minister all the best for a speedy recovery from this bout of COVID. I was able to have a good conversation with him a little while ago about energy policy, about the economy and about issues more broadly. He's in really good spirits. He's doing as the doctors advise us to when we get COVID. He is obviously isolating at home. He is doing some work and I have had that opportunity to speak to him before, and I wish him a speedy recovery. Today we've got news that the Independent Reserve Bank has lifted interest rates once again. This is the 8th consecutive interest rate rise since before the election in May. It means that the cash rate is now 3.1%. 8%. This is another $75 a month that Australian homeowners need to find for every $500,000 that they've borrowed. These interest rate rises are already having harsh and heavy consequences on a lot of household budgets and on a lot of mortgage repayments. But the full impact of these rate rises is still to be felt in the economy. So already having a harsh and heavy impact on repayments, but as the RBA has made clear today, we expect that the full impact of these rate rises will be felt down the track. Now, this is a key reason why the Treasury, in the forecasts that they provided for the October budget, expects our economy to soften next year. Our economy is expected to soften next year and growth is expected to slow as a consequence of higher interest rates as well as the downturn in the global economy. That's driving a softening of consumption in our forecasts, and that's feeding through into a lower growth forecast as well. And the Reserve Bank statement today makes it quite clear that they also expect household spending to slow over the period ahead, although the timing and extent of this slowdown is uncertain. And so that's one of the key conclusions in the statement provided by the Independent Reserve Bank today. We will get the national accounts for September tomorrow. The September national accounts will obviously be backward looking and they won't capture all of the uncertainty that lies ahead in the global and domestic economy. The national accounts that we see tomorrow will capture some of the uncertainty, but not all of the uncertainty that we're seeing in the global economy. Now, here in Australia, we have a lot going for us in our economy. We've got very low unemployment. We're seeing the beginnings now of some welcome wages growth, and we're getting very high prices for a number of our commodities, which is feeding through to the budget as well. And so we have a number of things going for us, but we are hostage to a number of developments over which we have no control. Obviously, the war in Ukraine is causing havoc on global energy markets. The COVID situation in China is something that we're monitoring closely, given the obvious consequences for our economy. There are some welcome signals out of the US, but we're still expecting a substantial tightening of monetary policy there. The UK is obviously in a very difficult position, as is Europe. The full impact of these interest rate rises from our own independent central bank are obviously still to be felt, and the magnitude of that impact and the timing of that impact is still in many ways uncertain. And of course, as always, as we approach the Christmas season, the festive season, obviously harsh weather events and natural disasters have the capacity to have a substantial impact on our economy and on our budget. And so when there are a number of things in our economy that we can't control, the government's job is to focus on where we can make a meaningful difference, and that's what the budget in October was all about. Our economic plan is about making the budget more responsible, the economy more resilient, and fighting inflation as our number one priority in economic policy. And that's what the budget was all about. Now, when it comes to inflation, obviously, high energy prices are a bigger and bigger part of the inflation problem that we confront in our economy. Australians are paying a hefty price for 9 months of Russian aggression and 9 years of coalition incompetence when it comes to energy. We have made it very clear that one of the most troubling aspects of the forecasts in the budget are the high and rising energy costs for our employers, but also for households right around Australia. And so we've made it clear that we intend to intervene in that market in a temporary, responsible and meaningful way. And a lot of the work that's happening now is directed towards that end. High prices for our commodities are helping the budget a bit, but they're hurting the economy a lot. They are helping the budget a bit, but they are hurting our industries, they're hurting our families and households right around Australia. And so we have a responsibility to act. And that's why we are doing so much work with the states, with the regulators, with the various industries to try and land a temporary and meaningful and responsible and sensible response to what we're seeing with high and rising prices in our energy markets caused by the war in Ukraine. We need to take the sting out of these energy price rises on behalf of industries and Australians right around the country. That remains our objective. We're doing a lot of work on this front with the regulators, with the states, with industry and with others to see if we can act in a meaningful, temporary and responsible way in this area. We intend to make our position clear and our plans clear in this area by Christmas. Obviously, with the Prime Minister laid up as he is with COVID, he's still working very hard to get to this outcome, as is Chris Bowen, Ed Husick, Madeleine King, myself, the Cabinet and others, to make sure that we can make our position clear on a responsible and temporary and meaningful intervention in the energy markets between now and Christmas. Over to you.
Is the government open to compensating the states for any intervention in the energy market?
Oh, we've made it very clear that we are prepared to negotiate with the states in good faith to see if we can come to an agreed position on these high and rising energy prices. Every Australian has an interest in a meaningful and effective and temporary response to these energy price hikes. And there have been important constructive discussions between the Prime Minister and his counterparts, the various state governments, in the lead up to National Cabinet on Friday. We welcome the spirit with which the various states are engaging with us on this really complex and difficult public policy question. We've made it clear that all options are on the table. We would prefer, where possible, a regulatory response here, but we've said that we are prepared to consider other options as well, including if there's a case for some responsible contribution from the Commonwealth, then obviously that will be part of the conversation.
We've seen estimates of billions of dollars. Is that in the ballpark?
Well, it depends on the outcome, and you know there are two different commodities in the mix here. We've made it clear in gas, for example, that there are some existing levers around the code of conduct. We're obviously working closely with the ACCC and others to see if there is a regulatory outcome in gas which would make a difference and be worthwhile and be responsible and temporary at the same time. Obviously, when it comes to coal, there's a greater role for the states when it comes to the regulatory and other levers. And so we're engaging with them in good faith. We're engaging with the states in a respectful and constructive way, and they are engaging with us in the same manner. And that's because we recognise we've got a big problem in our economy here. High and rising energy prices risk hollowing out our industries and smashing Australians right around the country, but particularly in the national energy market. And so we will continue to work closely with them, with the states, with the industries, with the regulators and others, everyone who has an interest in getting a good outcome here.
If that's too hard, would you go down the path of windfall profits taxes?
That's not our preference. You know, our preference is not to go down the tax path if we can avoid it. We've made it clear publicly and privately to a number of the companies and peak organisations involved here that our preference is not to go down the path of a windfall tax. Our preference is a regulatory outcome. If that requires the Commonwealth to come to the table with a sensible contribution to that outcome, then obviously we're prepared to discuss that. But we'd like to do that without resorting to some of the tax proposals which have been put forward in the public conversation.
How soon after the intervention would you expect power prices to start moderating?
Well, it depends on the nature of the intervention and the magnitude of the intervention. But clearly what we're most focused on is the price rises forecast in the budget for next year. You know, if you could just flick a switch and make this challenge go away, then somebody would have already done it by now. There's a lot of complexity involved here, a lot of negotiations, a lot of moving parts. And one of the reasons why we're doing this as urgently as we can, but in the most considered way that we can, is because we want to make sure that any intervention in the market works and that we factored in a whole range of considerations. And so our target, our objective, is to take some of the sting out of these price rises next year. That's been our objective all along, and it's on that basis that we've been engaging with so many different stakeholders in these markets.
Why is the prospect of a cap on coal prices proving more difficult than a cap on gas?
Well, there are different levers depending on the commodity. And in the gas market, the ACCC already has a substantial role. There is already a code of conduct, which we've said previously we'd like to explore making mandatory. And there are other levers in gas markets which are different to the levers available in coal markets. You know, what we would like to do, if we can, is to protect our reputation as a good international partner when it comes to supplying some of these commodities to the world. We would like to avoid a tax outcome if we can, and so that means the focus lies, whether it's in gas and or coal, in a regulatory solution. And again, if there is a role to play for the Commonwealth budget in a limited way, but in a consequential way, then obviously we'll consider that too.
And where are the negotiations at with the states?
Well, the Prime Minister's had a number of important conversations with his colleagues in the states. Chris Bowen has an opportunity on Thursday, I believe, to meet with his ministerial counterparts, the energy ministers from the states and territories, in the lead up to the National Cabinet meeting on Friday afternoon. And so there's a lot of engagement going on. There's a lot of constructive and I hope productive conversations going on. The Prime Minister is still working hard towards an outcome despite being at home with COVID, and those conversations no doubt will continue. But we bring to the table in these negotiations a respectful approach. We want to be constructive about it. We recognise the pressures on the states just like they are on the Commonwealth. And what we would like to do is to try and get to an outcome which serves the interests of Australians, Australian industry and the Australian economy, and I would have thought everybody's got a stake in making that work. Thanks very much.